All right, here we are. So tonight we're doing a lot of Black-Scholes modeling, which will be fun. Also, it involves a lot of Excel, which is even better. So let's get everything open. Here's the notes. There's two templates that I sent you for Black-Scholes, and get those open. And then we also have the binomial option pricing model, which is used for American options. Because Black-Scholes is not capable of doing American options. So let's see, what else do we have here? A lot of goodies already set up in Excel, which is nice. All right, so let's see, is everything open here? Yes, it kind of looks, all right, so yes, all right, so as we go along, we'll see what all of this is for. Okay, so first things first, what we're doing tonight is actually pricing options. Up to this point, we've kind of skimmed over that area. Last week, we looked at boundary conditions for option prices, but we never quite got around to addressing how exactly are options priced in the marketplace. So this is a fairly complex area, but luckily Excel can save us a lot of the grinding out, let's say, and we can do all the work directly in our spreadsheet. And so that will help us a lot, but we do want to understand what exactly these models are doing, because it gives us a lot of insight into how options are priced in the marketplace. So we start out by looking at the key features of the Black-Scholes model, and then we're going to understand how the original, oh, what happened here? The original model was only the original paper that Black-Scholes wrote only did one thing, and that's price European call options on stocks that did not pay any dividends. So it was interesting and important, but it turned out later on that it could be extended to price just about any option out there except American options. Okay, that took a while. I mean, a lot more research was needed to be done before it was demonstrated that Black-Scholes could be extended in a lot of different directions. We're going to see how that worked out. We're going to see how put-call parity ties together European calls and puts. We've already done some of this, but we're going to look at it again tonight. And then we're going to see how the fact that the Black-Scholes model can't price American options doesn't have to be a problem, because we have this binomial option pricing model, which is able to price American options. This appeared in print, this model, about 3 years after Black-Scholes. And the interesting thing about this binomial option pricing model is that originally the purpose of it was simply to explain to people what's going on behind the scenes with Black-Scholes. And then it was pretty clear fairly quickly that we could use this model to price American options. And so that's why it proved to be so important, because as it turns out, most options in the marketplace are actually American style. So the Black-Scholes usefulness would have been limited by the fact that it can only price European options had this other model not come along. Anyway, so let's take a look at a quick brief history of the Black-Scholes model. The model appeared in print in a paper in the Journal of Political Economy in 1973. It was co-authored by Fisher Black, Myron Scholes, and Robert Merton. And its only purpose initially was to price European call options on non-dividend paying stocks. Now, keep in mind, these guys are academics. They thought they'd found something interesting, and they got it published, although it took a long time. Ironically enough, I believe it was 8 other journals that turned them down before the Journal of Political Economy accepted this paper, which proved to be one of the most important papers in basically the history of financial and economic journals. I mean, it was like, imagine if Einstein presented his theory of E equals MC squared to different journals and they turned him down. So it's essentially, it's at that level within finance. But anyway, so the paper came out and everyone thought, well, that's interesting. But it was Robert Merton, one of the 3 of them, who was able to later on extend the Black-Scholes model to price a wide variety of other types of options. And if it hadn't been for Merton's work, we might not have ever heard of Black and Scholes, because it would have only been useful for one type of situation, and that's it. So Merton really is the key in making the Black-Scholes model so useful. And the interesting thing is the model is only called Black-Scholes. Now, why did that happen? Because Black and Scholes worked on this project for a while before Merton came along, and they invited him to join the project. And apparently, when it was finished, and they sent the paper to the publishers, they offered to call it the Black-Scholes-Merton model. But Merton apparently said, "No, that's all right. Don't worry about it. You can just call it Black-Scholes." But everybody knows that it was all three of them who published this paper, Black, Scholes, and Merton. And of course, Merton later on is the one who, like I said, wrote more papers to demonstrate how the Black-Scholes model could be extended to price other types of options, although not American style. So anyway, now the original Black-Scholes model did not mention anything about puts, but a put call parity condition was developed to show that once you have a call option priced by the Black-Scholes model, you could turn around and use put call parity to price an equivalent European put option. In other words, a put option that has all the same features, the same underlying asset, the same strike price, and the same maturity date. So that means there wasn't any need for a second model to price puts, because it could be taken directly from Black-Scholes results for European calls, and then using the put call parity condition, it became possible to also price European puts. Now, the Black-Scholes model, like all models, is based on assumptions that may or may not be realistic. But the reality is that a model's usefulness doesn't really depend on how realistic its assumptions are, but how well it works in the real world. And so in that score, the Black-Scholes model works very well, even though several of the assumptions that it's based on are not necessarily true. So what exactly are we assuming here? All right, well, first of all, we're starting by assuming that the returns of the underlying asset are normally distributed. Now, that is true to a large degree, but it's not perfectly accurate. There are ways in which the returns to the underlying asset, or any stock in general for that matter, is not exactly normal. So I'm going to attempt to draw a picture which illustrates exactly in what ways the returns to stocks tend to not be exactly normal. So first of all, let's see. I'll use black to represent the normal distribution. All right, that's the normal distribution. Now, the actual distribution, and this is not obviously every single stock in the market or every asset, but in general, empirical research has shown that there's a tendency for two things to be going on here. Number one, there tends to be more area in the tails. Number two, actually, I don't think I should have drawn it like that. Hold on. Let's try that again. It's okay, I guess. So anyway, black is normal. Red is actual empirical returns from knowing from historical experience. So two things are notable here. Number one, the tails of the actual returns are fatter than the normal distribution. And number two, I'll sneak it up here. The actual returns are what we call negatively skewed. Okay, as opposed to being symmetrical about the mean. All right, so what does this have to do with anything? In other words, what exactly is going on here? Why does any of this matter? Or at the very least, what are the consequences of all this? So let me leave it there for a second so you can catch up with it. Why should we care about any of this? All right, so because the tails are fatter, what that basically means is that you're more likely to get extremely large or small returns than you would get with the normal distribution. Okay. So the fat tails for the actual returns to financial assets indicate that extreme returns, both positive and negative, are more likely than would be the case with the normal distribution. So in other words, the returns are more likely to be well above the mean or well below the mean than you would get if the returns were truly normal. So what that really means is that they're riskier than we realize. That's really the key detail. In other words, the returns to assets are more uncertain than they would be if they were truly normal. And number two, the skewness part basically means, that's number two, this negative skewness of the actual returns means that there is an imbalance between gains and losses in favor of losses. With the normal distribution, there would be a balance between gains and losses. So in other words, it's like you're playing a game where the odds are somewhat against you, like in a casino. If you keep playing long enough, eventually you'll lose in a casino. And here, if rates of return are slightly negatively skewed, it's almost the same thing, because on balance, you're more likely to lose than to win with financial assets, rather than what you would get with the normal distribution, where there's a nice even balance between gains and losses. So those are the consequences of this assumption not being, strictly speaking, correct. Now, it's not that far off. I mean, I don't want to give you the impression that the returns are not even close to being normal. They're very close, but there's a couple of ways in which they're different. All right, what else? Number two, volatility of the underlying asset is assumed to be a constant. Well, that's not true either, okay? Volatilities can change over time. And in fact, they often do. Now, I'll show you how you can tell. Volatilities can change significantly and are not necessarily constant during the lifetime of an option. For example, if an option is written on Apple stock, the Black-Scholes model assumes that the volatility, and by the way, the volatility is just another name for the standard deviation of the returns to Apple stock. Is constant during the lifetime of the option. This is not necessarily true. Now, just to give you a sense of how much volatilities can change over time. There is an index that's been created within the last 25 years called the VIX, which basically is a measure of volatilities of the Standard & Poor's 500. And this index is actually derived from options, from option prices. So what this means is that this is the index, and you can see that it bounces around quite a bit, which means that volatilities can change pretty rapidly, as a matter of fact. So although this refers to the S&P 500, you can be sure that each individual stock, potentially at least, has a volatility that can bounce around quite a bit. If Black-Scholes was strictly speaking correct, you tend to see this line be very flat over time. It could move around a little, but not like this. I mean, this is showing that volatilities can change very quickly in the market in response to new information. So now, having said that, though, if you notice over time, the index itself, I guess that's as far back as they have. You see the index goes through periods where it is very stable, and then it goes through periods where it bounces up and down. So sometimes volatilities are fairly stable, and sometimes they're not. Now, the index itself was only created, let's see what Max tells us, in the early 90s. Okay. It was actually created, believe it or not, by a professor at Duke who said, he wrote a lot of papers in which he explained why this type of index would be a good idea to have. It gives people an idea of what volatilities are doing in the market. But also, interestingly enough, you can actually buy futures contracts and options that are written on this VIX index. So in other words, they give you an opportunity to bet directly on volatility, just like butterfly spreads or strangles or straddles. But you're going about it in a different way, because with a straddle or a strangle, you're looking at a single stock, whereas here you're looking at basically the overall market. So the trading in these VIX futures and options is quite large, as you can probably imagine. The volume is enormous, and that's because it's a good way to hedge the risk that markets suddenly become more volatile and increase the uncertainty in the economy. So anyway, now keep in mind, when Black-Scholes were writing, it was the 70s. Most likely, the index didn't exist in the 70s. But if it did, most likely it would show that volatilities were much more stable at the time, and that what they were saying was probably more accurate. Now, though, you can see that that is really maybe the biggest violation of all the Black-Scholes assumptions, the assumption of constant volatility. Now, in Wall Street, there are a lot of these brokerage houses, investment banks, have their own proprietary methods for tinkering with Black-Scholes and trying to improve it a little based on these assumptions. But this is the standard Black-Scholes model. We're not going to do that here. But yes, this is one of the real drawbacks, assuming constant volatility. Now, the models out there that do not have constant volatility are so horrendously complicated that it makes you wonder if it's worth the extra effort to bring into these models changing volatility. But the Black-Scholes model itself is still used on Wall Street in spite of its holdups, its drawbacks. And so that kind of shows you that the results that it gives us are quite good, even if they're not perfect. All right, so what else are we assuming here? Oh, now this is something we don't have to worry about. The risk-free rate of interest, which means basically the yield on treasury bills, which are of the same maturity as the option, is a constant during the lifetime of an option. That's not a problem. Interest rates don't really fluctuate all that much, certainly not compared to volatilities. So that one we can live with. All right, now, with all that being said, as I mentioned earlier, Merton, in a series of papers in the early 70s, was able to demonstrate how we can extend the Black-Scholes model to price options on other underlying assets like commodities and currencies and interest rates and all the rest. And so that proved to be hugely important because, like I said, otherwise the Black-Scholes model would have basically disappeared if that wasn't the case. Anyway, so we're going to start by looking at the formula, the standard original Black-Scholes formula. Now, there's some very scary parts to it, but we'll work with that in Excel. In fact, we may as well open up Excel example number 1. Let's see, hold on. What is this? This is it. This is it. So what I've done here is I've put in the raw data, and then what we're doing over here is figuring out what to do with it. Okay, so imagine the following. So here's the model. So what we need to do first is identify what all these variables actually mean. Well, as you can probably guess, the C is the price of a European call option. S is the asset price, which in our example is a stock price. X is the strike price. R is the risk-free rate of interest, and T is the maturity date, or the time to maturity of the call option, where time is measured in years. Now, obviously, ND1 and ND2 are going to take some explanation. So what we'll do here is first show what D1 and D2 actually mean, and then we'll talk about this N. All right, so what is D1? Oh, by the way, here's the list. The N is actually a special function, which we'll see in Excel. It's formerly known as the cumulative normal distribution function. It sounds very scary, but if you've ever seen the normal distribution, you'll see that this is not complicated at all. In fact, while we're discussing it, I might as well show you a picture of what this thing looks like. So you know that the normal distribution has the standard bell-shaped curve. Oops. You may also know that there's actually an infinite number of different possible normal distributions, each of which has its own unique mean and standard deviation. So here we're looking at the standard normal distribution. And this one gets that special name because it has a couple of key properties that are very useful. The mean is 0, and the standard deviation is 1. Okay, so remember, these are the Greek letters. This is mu, and this is sigma. And they represent the mean and the standard deviation of a probability distribution. And here, the values happen to be 0 and 1. So you could actually draw the center right here, the mean. Okay, the standard deviation simply tells us how spread out the curve is. Now, suppose that I have a value of some kind. So calculate, who knows how, but Z equals, let's say, 1. In this scale, 1 represents 1 standard deviation above the mean. So the probability of this happening is equal to the area under this curve to the left of 1. Well, how much is that? Well, I'm going to show you right now, although we'll see more of this later on. In Excel, it has a, oh, okay, hold on. There we go. We'll explain this again in a minute. I just want to show you how Excel would handle this. Okay, so the name of the function you're looking for is called equals norm.s.dist. And you're going to tell it two things, 1 and 1, which stands for, hold on. I didn't realize it was going to do that. All right. Okay, so actually, you know what I'm going to do? Let me get rid of that 1 and the 1. This is the z-score, or z-value, and this is a parameter that stands for cumulative. And so what you're actually doing here, in our example, is you're telling it two things. What's the value of z? Cumulative equals 1 simply means true. Okay, so the first one means that we are looking for the probability that z is less than or equal to 1. The second one means that this is a cumulative probability, which means a less than or equal to probability. So that turns out to be 0.8413. Now, all probabilities under the normal curve correspond to areas. The entire area under the curve equals 1. Okay, so in other words, this 8413, we'll round that down a little, means 84.13% of the total area under this curve, which means there's an 84.13% chance that z is in fact less than or equal to 1. All right, so if this is not making any sense to you, don't worry, we'll do a few of these and you'll start to get the hang of it pretty quickly. So if you come back to my graph here, not that one, this one, this equals 0.8413. And why am I even mentioning this? Because that n function is doing exactly that. N1 means, or n of 1, means we're looking for the probability that z is less than or equal to 1, which turns out to be approximately 84.13%. So in the Black-Scholes model, we see this twice. Both of these are cumulative probabilities. Okay, so I thought maybe we might as well knock that off right now to get a better feel for what this nx represents. It could be any variable, by the way. We're just happening to apply it to z, the standard normal distribution. All right, now, what about this mysterious D1 and D2? These are just basically, I guess you could think of them as shortcuts. What you normally do is you calculate those separately before you apply that n function, because they're very, very messy. All right, so let me show you what D1 looks like. So this is D1. You can see, yes, it is a bit of a mess. And here's our old friend sigma, which, as you know, is our standard deviation. Other than that, the rest of these variables, you've already seen them. All right, and you can see why we don't just plug this right into the formula. These are normally done separately before you substitute them back in, because otherwise you're bound to make a terrible mistake. Now, luckily, again, this is where Excel comes in so handy. It's so, once you've got this monstrosity typed into your spreadsheet, you never have to worry about it again. Just change the numbers. Yeah, I think I used that word correctly. Monstrosity. All right. One more thing. This sigma, this is also, I forgot to mention, this is also referred to as the volatility of the underlying asset. So when you hear that word volatility, this is what you're actually referring to. Okay, so when we bring all that together, we have our Black-Scholes model. Now, the Black-Scholes model itself isn't really all that dreadfully difficult, but the derivation of it is quite scary. It involves literal rocket science, and it involves a lot of math that was actually borrowed from physics. So, and so you might have noticed that a lot of physicists work on Wall Street, and it's because it's the same math in a lot of cases, where when we model derivatives, they follow a lot of the same processes that you would see in physics. All righty, now let's see a quick example. And again, this has all been set up for you in Excel so that we don't waste so much time typing. We just want to understand what's going on. So we have a 1-year European call on XYZ stock, no dividends. The strike is $50. The 1-year risk-free rate is 2%, which means a 1-year treasury bill rate. The XYZ stock is currently selling for $52. The volatility of XYZ stock on an annual basis is 30%. So how do you calculate the Black-Scholes price of this option? Well, you can see that it clearly is in the money. It's $2 in the money because the strike is 50 and the stock is selling for 52. The strike is 50. So the option is $2 in the money. So that means that this option has to be worth a minimum of $2. Otherwise, there'd be an arbitrage. But we already know from last time that the option also has a lot of time value. And so the question is, how much should the option actually be selling for? Now, I'll give you a hint. This is a 1-year option. Most options don't really last that long. Most of them have maturities of no more than 6 months. So that means there'll be a significant amount of time value in this case, more than you might realize. Okay, so let's go to our spreadsheet now. And you can see this is Black-Scholes example number 1. And I've plugged in all the numbers. Now this sigma is clearly, I wrote it out in English. I think it has the capability of doing symbols, but I'm not positive. Oh, what the heck? Let's see what we can do. Oh yeah, there it is. There's our sigma. So that's our volatility. So these are the inputs to the problem. This is all we need. We've got the stock price, the strike, the risk-free rate of interest, the volatility or standard deviation, and the time, which is 1 year. Now over here, what I've done is I've shown you how to calculate D1. This is the Black-Scholes formula right here. But first we need to know D1 and D2. Luckily, by the way, D2, I think I forgot to show you this. D2 is a very simple extension, no, here it is, of D1. Once you know D1, D2 is easy. The challenging part of all of this is D1. That's my opinion. So here's what I've done. I've plugged it in for you so you can visually see that it does in fact turn out to be approximately 0.3474. But if you throw in the Excel, now look at this function. Ooh, you don't want to do that by yourself unless you're really good at Excel. No, not if this is your first time with Excel. But that is just this formula over here on the right. Well now, then D2 is easy. All right, so you should all have a copy of this, by the way, so you don't have to sit there and type away while we're doing this. You can go ahead and just observe that this is how D1 is calculated. And D2 then is taken from D1, and you can see all you had to do was take D1 and subtract sigma times the square root of T. So that guarantees that D2 is always less than D1. And then the fun begins. We have ND1 and ND2. Okay. Okay. Now, in Excel, as I just showed you, oh, by the way, I forgot to mention this. The thing about Excel that in recent years, Excel, when it first came out, it worked just fine, but they're constantly working on it. They're constantly trying to improve it. So what they did was maybe 3 or 4 years ago, they decided to go through and make the formula names a little bit more consistent. And in the process, they added a bunch of new formulas, but they kept the old ones as well. So if you look here, you'll notice this isn't what I showed you before. It's just spelled out norm as dist. If you use that, it'll work. You only then need one piece of information, which is D1. It's going to assume that you mean cumulative, whether you do or you don't. If you want to switch that to norm.s.dist, you certainly can feel free to do so. It's after all, it's your template. You would change it to norm.s.dist, but then you would have to provide a second piece of information, which is cumulative equals 1. That's up to you. The way it's set up now, it still has the older version of norm.s.dist. If you want to update it, you can. You don't have to. All right, just saying. Now, the same thing holds here for ND2. If you want to update that, you would put norm.s.dist. Then you would need V8, 1. And there's your ND2 and ND1. And these, again, are cumulative probabilities. Now, the last step is to plug everything into what you see up here. So one thing you may not have known about, you see this e to the minus RT. In Excel, that's expressed as EXP. As you see here, where it's e to the minus RT, that's this piece right here. In Excel, e raised to some power is expressed as EXP, and then you put in there the exponent. All right, so you've got B1, which is S, times B9, which is ND1, minus X, B2, times e raised to the minus RT power, all times ND2. All right, so because this is not really an Excel class, if you don't get this, it's okay, but it would be nice if you could get it on your own. But this is how it's done. Now, if you, this is the call. Now, if you notice, the call price is $7.63.3. Up here, if you remember, we discussed this, the so-called intrinsic value is the difference between these two numbers. That means that if this was an American option, I could exercise it early and collect a payoff of $2. So in order to avoid an arbitrage, the price of the option must be at least $2, but it's probably going to be higher than that, depending on the time value. Here, we've got a lot of time value because there's a full year left to maturity. So in fact, in this case, the time value is $5. Let me add this here. The price minus the intrinsic value is 5.633. All right, so that's a lot of time value. It's worth, the time value is more than the intrinsic value. Now, here's a picture to show you what's going on with that. So the black line is the payoff, the red line is the market price. You can see at $52, the market price is 7.633. The intrinsic value is $2. Therefore, the time value must be the difference, which is 5.33. Oh, sorry, 5.633. That's a lot of time value. But that's what the option is worth because it represents the possibility that in the future, the option could become more valuable. And that's what you're paying for. All right, so that was our first Black-Scholes result. And what we need to do now is come up with the equivalent put price. In other words, I would like to know how much a put would cost that has the same strike, the same asset, and the same time to maturity. So this is the formula when there's no dividend or of any kind. It's the simple basic put call parity condition. And you can see here I've rounded it slightly. It is $4.65. Okay. Now in the spreadsheet, I've got it all worked out with all the formulas. So right here, yes. Now, by the way, I have actually done it in two different ways. There's actually two different ways of calculating a European put price. And we'll see if it's in the slides. I think it is. But if you're using the put call parity condition, it's right here. So you've got, it's listed over here. See if I can fit all that together. Oh, there it is. I did sneak it over here. Okay, so you've got the call that we just calculated, 7633, plus the present value of the strike price. Now that's X e to the minus RT minus the stock price, which is 52. And the net effect is the put price is 4.643. Most of the time, much of the time, I should say, puts are worth less than calls. All right, but and that's what happened here. Now it turns out though that there's a way you can rearrange the Black-Scholes model algebraically to solve for P directly without first calculating C. I think, let's see. Oh, I don't know. I guess I didn't leave it in here. All right, let me write a few for right now. All right, so I'll put it down here. As an alternative to using put call parity to price European put, the following formula can be used instead. And that's what I have right here. This is the alternative approach, which I'll show you right now. And it looks like this. Okay, basically, what's happening here is that we've sort of combined the Black-Scholes formula with put call parity and rearranged it algebraically to solve for this. So if you notice up in the top here, I actually did enter separately the values of n negative D2 and n negative D1, just to make it easier to implement this formula. Okay, so, it saves a little time. I don't know how important it really is, but if you scroll up, you'll see that I've done the put price in two different ways. This is the second way. But in order to do that, I need to first calculate n negative D1 and n negative D2, which I did over here. And you can, as you can imagine, it's just the same thing we did over here. It's just that I changed the signs. So then I can plug everything in here. All right. Let's see what I can do here. I should be able to split the screen. There we go. So if you look at this formula very carefully, oh, wait a minute. Why is it doing that? All right. So in other words, it's x e to the minus rt. E10 is over here at nd2. 10. E10 is n negative d2 minus s, which is way up here somewhere, n negative d1. So that's what we're doing here. So for puts, you can do either one. It doesn't really matter. All right. Well, that seems like a lot of work, and it kind of is, but well, all right. What do you expect? These are very complicated products. Now, what about the case where, and this is Merton's contribution, by the way, what if we want to price an option written on an asset that actually does provide cash flows to the owner? In other words, dividend-paying stocks, currencies, bonds, stock indexes, you name it. If there's any cash flows involved, the Black-Scholes model, the way it's written, doesn't work. But the adaptation proved to be surprisingly simple. And again, it's Merton that we have to thank for this. So what we have to do, now, by the way, I'm assuming that there's a continuously compounded return to this asset. Everywhere there's an S in the formula, we replace it with SE to the minus QT. Okay, think of that as the so-called X dividend price, meaning that the price after a dividend is paid. But instead of having discrete or periodic dividends, we're going to assume that the dividends are paid out on a continuous basis. So then the formula is only slightly different, and I mean only slightly different. For example, here's one difference. Okay, not much of a difference. And then the next difference will show up in D1. Okay. And this is where you notice the difference. Okay, so that's it. Can you believe it? There's only two differences. But they're important differences. Of course they are. And Merton was the one who came up with these ideas. All right. Now, here's an example. Now, by the way, this one refers to a different spreadsheet. This is Black-Scholes number 1. Now let's open up Black-Scholes number 2. This is different. This is one I just created on the spot to review a little bit of the normal distribution. Let's go get normal Black-Scholes number 2. And you can see it's not a whole lot different. What's happening here, we have a stock that sells for $30, and it provides a continuously compounded dividend yield of 3%. So the owner of this stock receives 3% per year automatically from the dividends. Okay, what that does is it actually reduces the value of a call because the owner of the call is not receiving those dividends. On the other hand, it's increasing the price of a put because that forces the price down. So the risk-free rate is 5%. What's the Black-Scholes price of a 6-month European call option with a strike of 28? Okay. So, one more detail. The volatility is 20%. So this is what we need to plug into our model. One more thing, don't forget time is measured in years. Therefore, it would be listed as 0.5. The rest of these are annual numbers. They're automatically adjusted in the model. All right, so here we can see in the slides what we have to do to get D1 and D2, but we may as well jump into the spreadsheet and do it there since it's right here, yeah. So this is D1. Well, first, this is the information for the problem. The stock price is 30, the strike price is 28, risk-free rate is 5%, the volatility is 20% per year. Why don't we sneak in there that little symbol? %20 per year. The time is half a year. The dividend yield is 3%. Now, we're going to start with this adjusted D1 formula. You can see it's, oh, you know what I did here? I'll tell you what. I just realized I broke this up into 3 pieces just because it's, I don't know, it just seems easier to me. This piece here is ln S over X. This 0.02 is the middle piece. R minus Q plus a half sigma squared T, and then this is sigma, the denominator that is. Okay, and so that means the formula, all I need to do is add these 2 terms together and divide by this one. And then, of course, D2 has the same relationship to D1 that it did before. We're taking, oh, and by the way, this is already here, so that's even more helpful. D1 minus this term, sigma radical delta, radical T. And then once again, I've got the old-fashioned norms dysfunction here, but it means the same thing. And D1 and D2 are calculated exactly the same way we did before. So we don't have to worry about them. And then the call price comes right here from, as you can see it. By the way, sometimes this version of Black-Scholes is called Merton's model because he obviously was the one who did all the work on it. So if you see that term in any books you're reading, this is what they mean. This modified version, which can be used to price just about every option out there, as long as it's European, is often referred to as Merton's model. Or you can think of it simply as an extended Black-Scholes. So you plug in the numbers that we have here, and you can see the price is approximately $3, $2.96, which makes sense because the intrinsic value is $2. So that extra 96.82 cents is the time value. Now, by the way, I do want to mention here that it's much lower than before because of 2 reasons. Number one, there's less time to maturity, but also number 2, the volatility is lower. So the time value of the option First, the time value of the option equals the market price minus the intrinsic value or payoff. The time value increases as time to maturity increases and as volatility increases. Okay, those are two things that are major determinants of the time value of the option. All right, so in other words, as time, with more time and higher volatility, the chances of a significant increase in the option's value increase as well. So that's why that's happening. More volatility means there's a higher chance of getting a very large payoff, as we saw last time. And more time, of course, means there's simply more time for the price to go up. So that's our price. Now, what about the put price? Now, the put call parity condition, which I haven't had a chance to show you, has to be adjusted when there is a continuously compounded yield. And here's where that shows itself. Okay, so let's put that into the spreadsheet. And you can see, yes, there's that extra Q there. And so when you plug that in, well, there it is, yes. It looks like a nightmare, but it's really not that complicated. Now, again, there's a second version of this that you could use, which requires the negative ND2 and ND1s. And so in that case, the other option we have, which is not very different than what we did on the previous spreadsheet, okay, so that's what you could also do instead. And without going through put call parity, you can plug your numbers in directly and you should get the exact same price. Okay, so now what we're going to introduce, now up to this point, we've only been talking about European options, European calls, European puts, initially just on stocks, but we can also apply them to many other assets in the market because of Robert Merton's research. Now, what's still missing from all of this is the ability to price American style options. Now, why is that? What's the holdup? Okay, well, let me just throw that in here. One of the key drawbacks to the Black-Scholes model, of course, is that it can't be used to price American options. This is because it is not set up to deal with early exercise. Because of the way the model is structured, it's not possible to determine if an option should be exercised early, which is what needs to be done in order to properly price American style options. So I mentioned that earlier. What do we do about it? Now, this time Merton was not the one who came up with the solution. And now keep in mind too, when all of this was going on, when Black and Scholes and Fisher were writing their paper, there was almost no option trading going on at all in the United States or anywhere for that matter. This was almost an academic curiosity more than a practical solution. But pretty soon it became clear that once options did start trading, that American options would prove to be maybe more useful than European options. So suddenly it became clear that there needed to be a model to price American options. So in 1976, a team of researchers, let's see, it was John Cox, Stephen Ross, and Mark Rubenstein, published a paper in which they presented Cox-Ross-Rubenstein CRR model for pricing options. Now, even here, this was really more for academic reasons. This was not published at an investment bank. It was, these were academics. They're at the big schools. I think Rubenstein, I've forgotten already, but at least one of them was at Berkeley. One of them, I think, was at Yale. One was at Harvard. So these are the heavyweights. And the model, the CRR model, was intended to provide insights into how the Black-Scholes model actually works. That was really their main motivation. The model takes the stock price and the option price and turns them into a series of steps along a tree or lattice so that it is possible to determine at every point in time whether or not the option should be exercised early. And so because of that, this meant that all of a sudden, for the first time ever, the CRR model could be used to price American options and yet maintained the same assumptions of the Black-Scholes model so that it would produce the same European option prices as Black-Scholes. And that's important because this way we know that they're following the Black-Scholes logic, and yet they've set it up in such a way that they can now demonstrate how American options would be priced in such a way to be consistent with Black-Scholes. So that proved to be amazingly helpful to traders and researchers because suddenly now it becomes possible to actually price American options. Now, the trade-off, though, is that it's a lot more complicated than the Black-Scholes model because it's a simple formula. relatively simple formula. So, but we'll see. We can take a look at some simple examples of how this works. Now, just to give you a feel for where we're going with this, you have to visualize that we're taking a stock. Let's say this is the stock price today. It's selling for $100. And because the model, which you saw up here, or you will see, is called the binomial option pricing model, that's a hint. That means we're going to model the evolution of the stock price in such a way that at every point in time, it can either go up or down. Let's say here the stock price goes to 105, and here it goes to 95. And then the next period, it can go up to 110, or it can come back down to 100. From down here, it can go back up to 100 or down to 90 at time 2. So this is this is why it's called binomial, because at every point in time, the stock price either moves up or down. And it forms what we call a lattice or tree. If you can visualize it turned on its side, it's kind of like a tree that only has 2 branches and whoops. So then we have corresponding to it, we have a tree full of option prices. And so I'll show you how this is done. So we'll also have a tree or lattice for option prices. And these will be taken directly from the stock price tree. These, by the way, these numbers are coming from a formula. A formula determines how much S moves up or down. Okay, the value depends on volatility. All right, so there's how far up and down the stock can go depends on the stock's volatility. It's a very specific formula. It's not a very complicated formula, but it's consistent with this type of binomial approach. And then for whatever option we have, we'll have a series of prices taken from the tree of asset prices. For example, you could have, let's say it's a call, you could say C equals 1, and C equals 3. Now here, the ups and downs can be very different from each other. So like you notice here, when the stock goes up and then down, or down and then up, it comes back to the same place. That isn't happening with the options because the relationship between the options is very different at the different nodes than the stock prices. Oh, one more thing I forgot to mention. Each point, this is a node, and this is a branch. Okay, we're trying to reinforce the idea that these are nodes. Nodes and branches reminds us of trees. It's supposed to basically be a sideways tree. Okay. Anyway, once we start actually doing this, it'll make a lot more sense. But I just wanted you to see where we're going. And then once this is in place, we'll fill in these option values. This is the actual price of the option right here. This is today. By the way, I forgot to mention these T's. This is today, 1 period in the future, 2 periods in the future, et cetera, et cetera. All right, so all of this is referred to as the binomial option pricing model, or the Cox-Russell. Now, by the way, since Cox-Russell-Rubenstein's paper came out, there have been several other papers which propose slightly different variations of this model. So the version we're looking at is Cox-Russell-Rubenstein, but there are others out there as well with different assumptions and different procedures, but the setup is the same. They're all binomial trees. Okay, now, one thing I do want to mention here, and this is something we've not had to do before. In this framework, we will calculate the value of the option at each node, but we will also, but for American options, we will also have to decide whether it makes sense to exercise the option at each node. In other words, with the European style, we don't have to think about this. With the American style, every point along that node, every node on that tree, rather, we have to stop and say, should we exercise or not? And that's going to complicate things quite a bit. All right, but that's why I set up the Excel spreadsheet for you. Now, we're making the same assumptions. Just want to throw that in there. They're keeping the same assumptions as Black-Scholes. And so each time the stock goes up or down, it goes up by a fixed percentage. Now, this picture that I showed you here earlier is a little bit deceiving because it's going up or down by $5. It's usually not quite that simple. It's usually going up or down by a fixed percentage rather than a fixed dollar amount. But this is a good picture for illustrative purposes. All right, so how do we figure that out? Well, the amount that it can go up or down, like I said before, is determined by the asset's volatility, which again is the standard deviation of the returns to that asset. All right, now, here's an unfortunate consequence of this. It turns out, now I think I may have mentioned this once before, half of the options books in the market use the letter X for the strike price. Half of them use the letter K. So it appears that I have somehow accidentally used K in this section of the slides when I was previously using X. So I just want you to be aware that it means the same thing. I don't know how that happened. I guess I was careless, but in the first half of this chapter, I was using X. Now we're switching to K, but just be aware this is also the strike price. Now here's some new stuff. U and D. If the stock goes up, U is the constant that tells me by how much it goes up. If the stock price goes down, D is the constant that tells me by how much it goes down. And then finally, we need to keep track of probabilities, which we did not have before. G is the probability that the stock goes up, And 1 minus g is therefore the probability that the stock goes down, because there's only 2 possibilities, up and down. So those probabilities have to add up to 1. Well, now, oh, and there's more. R is the risk-free rate of interest. We've already seen that. That's not a problem. Now, one thing we didn't think about here is, let's look at this tree again for a second. If these time steps are 1 year apart, I'm going to define the variable delta t to tell me how much time elapses between steps. It doesn't have to be a year. It could be a month or a day or a week or whatever. So delta t simply means how long goes by before the next time step. All right, that's an important detail. All right. Same thing here. You could think of this as delta t and delta t. Okay, so here we go. Let's jump ahead just a little bit. And okay, now, oh, by the way, this is important. You would think that we would use the letter C to represent call prices and P to represent put prices. The problem with that, though, is that eventually we'll have a conflict, and you'll see why later on in the namings of these different variables. So just to keep as simple as possible, we're going to use the letter F. It can be either a call or a put. So, and this is what John Hull's book does. It's a very clever idea, because C could be confused for other variables, and so could, like cash flow, and P could be confused for other variables like probability. So F, if it's understood that F means it's either a call or a put, but that's the price of the option. Now, notation-wise, if the stock price, the option price goes up 1 step, we're going to call that FU. The U is a subscript that means U, or up rather. D, as you can see down here, means it goes down. So in other words, if you can imagine a little tree right here, here's F, and in time 1, there's 2 possibilities. It can go up to F sub U or F sub D. These are not multipliers. These are subscripts. Now, I just want to point out then that if we have 2 time steps in our model, we have to extend this a little bit further. These subscripts can start to really pile up in a hurry. So let me show you what the tree would look like if we had 2 time steps. As a matter of fact, I'll tell you, let's do this. I've mentioned here that U is the size. This is for the stock. It goes up or down. It goes up by U, it goes down by D. So let's just see if we can get these all together in one nice little slide here. I think we can do this. And I want you to see there's one thing that's potentially very confusing. And let's say it goes up, there's one more opportunity. Let's say it's a 2-period model. If it goes up, now here U is a constant. It's being multiplied by S. Down here, D is a constant. It's being multiplied by S. So we go up a second time. That brings us to u squared s. If we go down, that makes it dus. If we go up, it's the same thing. And if we go down, it would be d squared s. But with the option, you do not have this kind of regular relationship. So instead, it's a little bit more complicated. So this f with the subscript of u does not necessarily equal f times u. It's a subscript. So we have to be very, very careful not to confuse the stock price tree with the option price tree. Now, once we've done an example, you'll say, oh, I see what you mean. Right now, we have to be careful not to get confused. So up here on the top, we're multiplying as we go along. Down here, that is not happening. The option prices depend on what's happening in the stock price tree. So for this one, we're going to call f with two subscripts of u. Okay, so the f's down here are uniquely determined by what's happening in the stock price tree. Okay, so one more step and then we're ready to get started on this. And what the challenge is filling in the trees, but again, Excel is so helpful in these cases that we can do it without too much difficulty. All right, now here's some restrictions on the variables that we're using in this model. These are just to prevent arbitrage. They're technical conditions, but they prove to be very important. First things first, the probability G of going up is bounded between 0 and 1, which means, I mean, you can say the same thing about 1 minus G. D has to be less than U. And e to the r delta t is also, for technical reasons, has to be between U and D. Otherwise, the model doesn't work. And we can make some further claims as well. For example, D must be strictly less than 1. And U has to be strictly greater than e to the r delta t. And don't worry, we'll see why that's true in a few minutes. All right, so some of these graphs we've already kind of seen. We don't necessarily need to go through them again. But the one thing I do want to mention here, though, is this. When we're talking about the stock price tree, if you notice when I drew this by hand, I called it US. US and SU mean the same thing. The same thing is true down here, because you're just multiplying two constants together. So don't worry about that. The order of the U's and D's is not relevant. In other words, US, SU, it means the same thing. This is, as I said before, this is the corresponding option tree. This is a one-period model. And here, the fact that these are subscripts, I'll make a note here, FU does not equal F times U. F sub D does not equal FD. In other words, these are subscripts, These are not multipliers. So let's see if I can make that a little clearer here. Yes, in other words, I don't want you to think that this means F times U and that this means F times D. It does not mean that with the option tree. All right, so we're going to start by looking at an extremely simple case. We're going to price a European call on this frame with this framework. This is just like the first Black-Scholes case. It's a non-dividend paying stock. We're going to price a European call option just to get the hang of this. Now, one more thing I forgot to mention. This is the probability of going up. This is the probability of going down. In other words, in order to do this, we have to assume that there's some probability that determines the likelihood of going up or down. So G is thought of as the probability of an upward movement and therefore 1 minus G must be the probability of a downward movement. They have to add up to 1 because those are the only two possibilities. So when we go through these trees, there's an implied probability of going up and down, which we will calculate at the beginning of each problem. All right, so we're going to look at the case of a one-period call, European call. The stock does not pay any dividends, so we'll keep it simple. And in one period, the stock price will either go up to S times U, or with probability G, or fall down to S times D with probability 1 minus G. So it sounds very abstract. And since the option matures in one period, in one time step, it'll be worth the payoff, or in other words, the intrinsic value. So here we're looking at payoffs. So on the maturity date, the option's value will equal its payoff, which could be 0, but it can't be negative. Now this is where it gets interesting. In fact, you know what I'm going to do here? I'm going to draw another picture just to reinforce this. So if we go up, now remember, this is a call. And of course, the payoff to European call, if we use K as the strike price, that means here it's actually max. Now here's the interesting part. In the upstate, the stock price is worth SU. And in the downstate, the stock is worth SD. Ooh, now we're getting somewhere. So this is how we can tell what the value of the option is at each node. The payoff hasn't changed, but we have this expression for the value of the stock. Now that raises the question though, what about here? If we know for sure that in 1 year, the option will either have a value of max SU minus K0 or max SD minus K0, what is it worth now? Okay, now before we do that, we're going to, and that's what this is right here. And then of course we have the probabilities. All right. Now, before we go any further, I just want to throw in a brief interlude here. We're going to look at something called expected values. Suppose, this is an example, that you are allowed to reach into a bag and pull out a number which determines the prize that you win. In this bag, there are 10 let's say we pull out a card with a number on it. Let's make it more clear. In this bag, there are 10 cards with a prize of $100, and there are, let's say, 40 cards with a prize of $200. What is the expected value of your prize? Good question. So in other words, whatever you've done, let's say you're playing a game and you've won the right to reach into this bag and pull out a card with a number on it that determines your prize. We have 10 cards that have a prize of 100 and 40 cards with a prize of 200. What is the expected value of your prize? In other words, if we keep choosing prizes, what is the average value of the prizes? So how would you approach something like this? Well, what we can do is the following. Let's make up a little chart. Since there are 10 cards with a $100 prize and 40 cards with a $200 prize, the probability of choosing a $100 prize is 10 out of 50. Actually, it's 10 out of 10 plus 40. 10 out of 50, which is 20%. The probability of choosing a $200 prize is 40 out of 50, or 80%. Okay, so what we're going to do is calculate the expected value of this prize in the following way. We have to take into account the fact that the probability of getting a $100 prize is different than the probability of a $200 prize. In other words, we can't just add up $100 and $200 and divide by 2, because that's not going to give us the right answer. So here's what we have to do instead. The expected value of the prize equals the probability of getting $100 times $100 plus the probability of getting $200 times 200, which is equal to 20 times 100 plus 0.80 times 200 and so that'll be 20 plus 160 equals 180. So it definitely is not halfway between 100 and 200. Because there's more $200 prizes than $100 prizes, the average should be closer to 200 than 100. And that's exactly what we have here. So that's what we want to review here. And this notion of expected value, what you can see is essentially it's just a weighted average where the weights are probabilities. Now, we also want to take a quick possible look at this next concept. Suppose that the prizes will not be delivered for a full year. For some oddball reason, the rate of interest is currently 10%. What is the present value of the expected prize? Well, for that, you would take the $100 and divide by 1 plus the rate of interest. Okay, equals 180 over 110, which is equal to $163.64. Okay, now, therefore, if that's the case, then no one, in principle at least, should pay more than $163.64 for the right to play this game, because that's really what it's worth to us, $163.64. Now, why did I mention all this? Because the options will be priced in exactly the same way. Okay, so in other words, we can figure out what an option is worth by following the same approach. In a similar way, an option's value equals the present value of its expected future cash flows. All right, in other words, what cash flows will the option generate for me in the future? What are the probabilities of those cash flows happening? And how much is that worth to me today? Because the option might not mature for another 2 years or 3 months or 6 months. I'm not receiving this money today. And so that's what the logic is behind everything that follows. The present value of its expected future cash flows. And just as a side note, we can make the case that the value of any financial asset equals the present value of its expected future cash flows. It's not something that's unique to the options markets. All right, so now we're just about ready to start doing some grinding here. But this is we're building up basically what we're doing here. Well, you'll see what we're doing when we get to it. Right now, we have to do some more theoretical background. When we're done with that, we're going to go in here and we're actually going to price some options. It's hard to tell just by looking at this, but wow. Yeah, this is a little tight, but well, you know, we could draw the pictures if we need to. But anyway, all right, so tell you what, since it's like 7:45, why don't we knock it off here? We'll get back to this in a little bit, and then we'll carry on. I'm going to go through a somewhat theoretical discussion, which you'll see it is pretty important, and then we'll do several real world examples here, okay? So what's coming up next is a little bit involved, but it's just giving you background to understand how we're ultimately going to price these options. Okay, so we're almost there. We're almost ready to price them. So I hate to leave you in suspense, but I think we can use a break. When we get back, we'll carry on and churn out some pricing from several examples that we have in the slides. All right, so let's knock it off for a bit. When we get back, we'll do some pricing. All right, let's do this. So, right. So what's happening here is that, you know what? Let's see. Yeah. Well, this shouldn't take but a couple of minutes. Basically, this is following the same logic as the Black-Scholes model. Basically, what we're doing is we're setting up a portfolio, which, now remember that we're assuming this is a stock option. We're setting up a portfolio which contains H shares of the stock. H is a variable, which we will determine as we go along. And in B, dollars worth of risk-free bonds, in other words, treasury securities. And so what we're going to do is put together a portfolio. And the logic here is that the portfolio's cash flows have to match up with the call option. And so if we are successfully able to do that, then the price of this portfolio will have to have the same price as the option. Otherwise, there'd be an arbitrage. Okay, now we saw a lot of that last week, where when we have two portfolios with the same cash flows, they have to sell for the same price today. Otherwise, there will be an arbitrage. So here, instead of having two portfolios, we have one portfolio, which you can see here is H shares of the stock and B dollars worth of the bonds. And then we're comparing that with the call option. The challenge is to make sure that the portfolio always has the same cash flows as the option. And if it does, then again, the price of this portfolio would have to match the price of the call option. So with this binomial tree, we're actually not pricing the call option at all. We're actually pricing this portfolio. And that makes it a lot simpler. So we are going to make the following claim. At the moment, the price of this portfolio is HS plus B because we bought H shares of the stock and B dollars worth of the risk-free bonds. So we're going to say that our portfolio price can evolve over time, just like the stock price tree. In one time step, if the stock price goes up, the stock will be worth SU. And in addition to that, because this is a risk-free bond, its value is growing at a rate proportional to the risk-free rate and the time that's elapsed. So the bond will grow from B to BE to the R delta T, where delta T is the time between these two steps. And in the bottom, in this case down here, the stock goes down to SD, but the bond will grow to the same price. So if this really and truly replicates the cash flows to the call option, well, we can make a couple of statements right off the bat. HSU plus BER delta T, assuming that the cash flows replicate the call option, will be worth FU in this period. This one will be worth FD. And in addition to that, the current option price, F, will be HS plus B. Anyway, so how does that help us? All right, so again, these are the two equations that we have. And it turns out that because we have essentially just two unknowns, there's only two unknowns here. H and B. And we have two equations that must hold in one time step. Two things must be true. Two equations, two unknowns. So if you were willing to slug it out with the algebra, you would find the following results in the next slide. All right, and then when you see them, you'll say, well, that doesn't look very simple, does it? No, but you'll see how important this is in about a minute. All right, so again, what we're doing now is we're going to solve what's called, we're not going to actually do the algebra right now. You'll have to take my word for it that this worked. And when we do this, we're going to see that the formula that we need to solve for H and for B are, ooh, now those look pretty messy. In other words, the result of all that solving is that this is my formula for calculating H. This is my formula for calculating B. These are all known constants taken from the two trees. So we'll have no trouble whatsoever solving for these. But right now, we're not going to solve for them directly. We're going to put them together into an interesting and obtain an interesting result. Now, remember before we mentioned that the tree for the option looks like this. And for this replicating portfolio, it looks like this. So what we're going to do now is set these equal to each other. And then we're going to substitute this expression for H here and this expression for B here. And we're going to come up with a very interesting result. And this will actually be a formula that we can use going forward to calculate the price of our option. All right, so let me give you a minute to catch up. All right, here we go. So after making all the appropriate substitutions, this is what we end up with. Now, this is where it gets interesting. Based on the definitions we had earlier, remember we had these conditions. Let me just go get them again. These are restrictions on the values of these parameters are called. Oh God, where are they? Here we are, these restrictions. In particular, D less than U, these are the two that we really need. D is strictly less than U, and D is less than e to the r delta t, which is in turn less than U. All right, let me sneak these in here. Well, what does that tell me? Well, first of all, it may not be immediately obvious, but these two terms, if I were to add them up, yeah, I'm running out of space here. These cancel out, and I've got U minus D over U minus D equals 1. So in other words, each of these two terms adds up to 1. And in addition to that, if you notice, based on this condition, this term is less than 1, and so is this one. So it's also greater than 0. So what that means then is that those two terms have the exact probabilities that they need. And oh, I've got these on the next slide. Let's jump ahead here so you can see it better. In fact, let me move this all together so you can see. Based on the assumptions we made earlier, which implies that these two terms may be treated as a special type of probabilities. But they're very special types of probabilities. They're not real world probabilities. Well, then what are they? Good question. Okay, well, if they're not real probabilities, what are they doing here? Well, they have a special role in derivatives pricing models. These have a special name, and this will require a little detour again, but let me show you what this is all about. They, let's see, let me scroll down here a little bit. We're going to let this first term be P and the second one be 1 minus P. Okay, we know that they add up to 1. So we're going to call this P. This is, or these are collectively known as risk neutral probabilities. Oh, let me fix that up a little. Now, this is a word that requires a lot of explanation. Now, we see this a lot in derivatives pricing models. What is that all about? What does it mean to be risk neutral? All right, so let's do a little detour here and delve into this world of risk neutral. And what we're going to see here is that there are actually 3 different types of risk preferences. That investors can have. The first one is called risk averse. The second is risk neutral. And the third is called risk seeking. Okay. So now we're getting a little bit into theoretical economics, but that's okay. This applies directly right here. So the first one, risk averse, you can probably imagine what that means. Averse means you like to avoid something, but it has a very specific meaning here. Okay, so risk averse means, or a risk averse investor requires compensation in the form of a higher rate of return in order to hold risky assets. Okay, so in other words, for example, if a 30-year treasury bond pays a 5% yield, the investor would require a higher yield to buy a 30-year corporate bond. since the risk is higher. Now, that seems like common sense. Now, of course, it's pretty clear that investors are risk averse. They're not all equally risk averse, but they're most likely investors are going to require some compensation in order to hold a riskier security. Well, then what about the other two types of risk preferences? A risk neutral investor does not require any compensation for bearing risk. He or she is indifferent to risk. Okay, so this investor would hold the 30-year corporate bond even if it has, or a 30-year corporate bond, even if it has the same yield as a 30-year treasury bill or treasury bond. Because they don't care. They're not concerned about risk. They're like, whatever, we don't care. Now, does such a person really exist? Well, that's a separate question. But we're assuming that this is possible. Okay. Now, the third one, the risk-seeking investor, would actually accept less compensation for holding a risky asset than a risk-free asset. That's because the investor obtains satisfaction from risk. Okay, this is a person who actually likes to take risks. And so this investor would buy a 30-year corporate bond, even if it has a lower yield than a 30-year treasury bond. Wow, that's bizarre. Well. Now, of course, we're assuming that in reality, we're assuming that everybody is risk averse, maybe not equally, but pretty much everybody needs to be compensated for holding risk. Anyway, so one of the consequences of risk aversion or risk preferences is how much satisfaction the investor receives from each additional dollar of return. Now, what does that mean? Well, think about this. Suppose all right, how about this? Suppose that an investor earns $1 million in 1 year and then earns another $1 million the next year. Does the investor receive the same satisfaction from the first $1 million as the second $1 million? And the answer is it depends. It depends on their risk preferences. So what we'll see here is that the risk averse investor for the risk averse investor, the satisfaction, also known as utility, of the second $1 million is less than the utility or satisfaction of the first $1 million. In other words, having $2 million is less than or provides less than twice as much utility as having $1 million. So the second $1 million is not as much fun as the first $1 million. All right. Now, how about the risk neutral investor? Well, you can probably guess that that'll be different, won't it? So you're probably aware. I mean, having twice as much of anything is not as much. It's better, but it's not twice as good. That's what we're basically saying here. But that assumes that you're risk averse. Now, if you're risk neutral, the satisfaction or utility of the $2 million, right? All right, let's put it this way: of the second $1 million equals the satisfaction or utility of the first $1 million. Therefore, having $2 million provides twice as much utility as having $1 million. All right. And then finally, for the risk-seeking investors, if there are any such people, utility of the second $1 million is greater than the utility of the first $1 million. Therefore, having $2 million provides more than twice as much utility as having $1 million. All right, so you got these three groups. Now, in derivatives pricing models, it is assumed that all investors are risk neutral. And you might say to yourself, well, that's ludicrous because that can't possibly be right. And the reason for this is that ultimately, the value of an option does not depend on risk preferences. And we're going to prove that in a minute. You can't say the same thing for stocks, that's for sure. The more people worry about risk, the more that'll definitely have an impact on the stock, that's for sure, or a bond. But not so with options. With options, your risk preference is completely irrelevant to the value of the option. So therefore, it turns out using risk neutral preferences makes the modeling of option prices simpler. So therefore, it makes sense to use risk neutral probabilities. In other words, since they're irrelevant, since risk preferences are irrelevant, why not just use the simplest case, which is risk neutral? And by the way, let me just point out another important detail here. The advantage of using, one great advantage of using risk neutral probabilities is that all cash flows can be discounted using the risk-free rate of interest instead of risk-adjusted rates of interest. In other words, we can discount every cash flow in these models by using the risk-free rate, which is directly observable. If we had to take into account risk preferences, we would have to estimate the appropriate rates of interest, and that would be extremely difficult to do. All right, so with all that background in place now, oh, by the way, just because maybe we have a minute or two here, just for the fun of it, I can prove to you that you're all risk averse very quickly and easily. Let me just throw this onto a separate piece of paper. There's no point in including this in the notes. Just as a quick aside here, this is one way you can demonstrate that people are actually risk averse. So suppose, for example, that you had the opportunity to play a game in which I flip a coin. If the coin turns up heads, you win $1. If the coin turns up tails, you lose $1. Most people would have no problem playing this game because they will break even on average. Suppose that the game rules of the game change, though, so that if a head turns up, you win $1,000, but if tails turns up, you lose $1,000. So even though, on average, we'll break even in this game, a risk-averse investor would refuse to play. Why? Well, an economist would say, listen, we shouldn't be thinking in terms of dollars. If we think of the outcomes in terms of utility, this makes sense. For example, winning $1,000 would be nice, but losing $1,000 could be a disaster. You could, for example, be unable to pay your rent that month. Therefore, utility of the win is smaller than what we will call the disutility of a loss. Therefore, on average, this game produces a negative utility. So that means you'll stay away from it because on average, while the dollars will break even, utility will not. On average, losing $1,000 is far worse than the benefits you'll ever get from winning $1,000. And so if you're risk averse, this is exactly how you would look at it. Now, if you are willing to play this game, though, a risk neutral investor would play the game or would be indifferent between playing the game and not playing, because the utility gain from winning would match the disutility or the utility loss from losing. And therefore, the investor would simply break even by playing the game. And then, of course, we have the risk-seeking investor would be willing to play the game because the utility of winning would exceed the utility lost by losing. Therefore, on average, this investor would come out ahead by playing the game. All right. So back to this. Now, here's what we're going to see. Based on all those calculations we did a few minutes ago with the so-called risk-neutral probabilities, we're going to find a very interesting result. In the binomial framework, expected value of the stock in one period could be written in the following way. Now remember, we're using, now you notice what we've done here, these are the risk neutral probabilities. So by using the risk neutral probabilities, we're going to discover a very interesting result. We're not using the real probabilities, we're using the risk neutral ones. And the time frame between the two is delta t. So in other words, the expected value of the stock price in one time step is a weighted average of the probability of going up to SU and going down to SD with probability 1 minus P. Therefore, by plugging in these numbers, this is going to reduce to something extremely interesting. Oh, okay. So in other words, the expected price in our delta t in the period in the future equals S e to the r delta t, which is the future value when earning the risk-free rate of interest. Okay. So in other words, using risk-neutral probabilities, the return to the stock equals the risk-free rate. And this is, which means that everybody is expecting that their investments will be worth or will earn the risk-free rate of interest in the future, which means that everybody in the economy must be risk neutral. Or the way to think about it is that the risk neutral probabilities are consistent with risk neutrality. In other words, everybody in the market expects the returns to all assets to be the risk-free rate in the future. So that means then that to price an option, we can simply use the risk neutral probabilities to come up with the appropriate value today. Okay, so in other words, you've got the stock tree, the option tree, F, FU, and FD. This is the present value. We need that because these cash flows from the option will occur in one period in the future, not today. So this is the expected value of the option at time t delta t. So what we're doing is we're pricing the option as we said before. So the F equals the present value of the option's expected future cash flows. Which is what we said earlier, all assets are priced this way, the present value of the option's expected future cash flows. But by using the risk-neutral probabilities to come up with that expectation, we can discount the cash flows with the risk-free rate of interest. If we use the real probabilities, let's see, I wish I had room here. You know what I'm going to do? I'm going to copy this onto the next slide if I can, just so you can see them side by side. Using risk-neutral probabilities, and then using real probabilities, what you would do differently is that you would have the rate of interest would be here. I'll call it R star, I guess. The G's are the real world probabilities. This R star is the risk adjusted rate of interest, which would be greater than the risk-free rate. It would have to be high enough to compensate risk-averse investors for buying a risky asset. The question is, how do you estimate R star? That would have been a massive challenge had Black-Scholes not come up with this risk-neutral framework. But because we're using risk-neutral probabilities, we're going to get the same price, but we get to discount all the cash flows with a risk-free rate, which is much more convenient than using a risk-adjusted rate. But the key detail here is that F is the same in both cases. If they gave us different results, we'd have to use the second approach, but they don't. This proves that we can calculate the price of the option without using the G's. And in fact, we're better off doing so. So this is the basic model that we use to calculate our option price in this risk-neutral framework. All right, now what I'm going to do here is I don't remember exactly which examples I put into these spreadsheets. There's several examples in the slides that we should look at. Now, by the way, if we run out of time tonight, we may be able to borrow some time for next week. I'm not sure because I don't remember what we're doing next week. Hold on one second. I'm getting a little concerned that I'm looking at the clock now. This is one of the more complicated topics, though, that we'll be doing. Oh yeah, these are risk measures that we apply to options. These, no, we don't have to worry about these. These probably won't take up the whole period. So, all right, let's just carry on. Ooh, I seem to have upset PowerPoint. All right. Let me just quickly save this before I lose my work. All right. So let's see what's in the spreadsheets. What I've done in the spreadsheets, I've set up nice little trees here so you can follow along the logic, I hope. But first we have to look at some examples. All right, let's just look at one right now. Actually, I think this is the same one. Oh, that's good. All right, so let's see what this is all about. So we have a stock that's selling for 103. This is on sheet one, by the way. In your spreadsheet, binomial option pricing examples, sheet one has the next two examples that we're about to look at, a European call and a European put. So here we're told that the stock is selling for $100. The 1 year European call has a strike of 100, and we have the following information. The risk-free rate is 3%. That U, which you know what I just realized? I didn't ever quite get around to explaining what U is and D. You know what? Let me sneak that in here somewhere. Yeah, I'll just throw this in here real fast. There we go. I just want to mention how U and D are calculated in the Cox, Ross, and Rubenstein model. So you don't think it just fell out of the sky. Okay, so U is equal to this is the Cox, Ross, and Rubenstein approach. And if you look at them carefully, you'll see that U equals 1 over D, D equals 1 over U. In other words, they're inverses of each other, which means that U times D equals 1. That was done on purpose for mathematical convenience. It doesn't have to work that way. So I just want to throw that out there. The other models that came along have different expressions for U and D, but the logic is always the same. All right. Oh, let's see how long that's going to take. It's getting to be a very bulky document. That's why I have to watch it. All right, let's give it a minute. All right, very good. Now, let's get back to what we were doing. Here we go. So we have this data, and so the risk neutral probability, this is the formula for, remember we had this earlier, for the risk neutral probability of moving up. And obviously then 1 minus P would simply be um, 1955. Now U is 1.05, D is 0.95. So after one step to the tree, S equals 100, SU is 105, and SD is 95. What about the options? All right, oh, that's here. All right. Well, this is a call with a strike of 100. So when we look at the option tree, remember the stock tree looks like this. Okay, so because the option matures at time 1, on the option tree, what we have is the payoff, which because the strike is 100, the payoff here is 5, and the payoff here is 0. So we're already largely done. All that remains is for us to calculate this F. Now, the F comes from that formula we had a minute ago. It's not taken directly from S itself. It's taken from these two. Okay, so specifically, we're calculating the expected value of these two future cash flows and then discounting them back to the present using the risk-free rate of interest. So in other words, this formula is what we're using. So we have F, we go up, we get $5, but the probability of going up is 0.8045. The probability of going down, 1955. That brings us down here where we get 0. And then here we have to discount everything by the risk-free rate for 1 year. And you can see by plugging the numbers, F equals $3 and 90.34 So given that there's a chance, 80% chance roughly of going up to $5 or almost 20% chance of going down to $0, today I should be prepared to pay $3.90.34 to buy this call option. Oh, so you can see it's a multi-step process. Now we can do the same thing with puts, but now what I've done here in the spreadsheet is I've set it up so it's becoming automated. In other words, it's set up so I could actually change these and automatically it'll update itself. So let's say I wanted to know what would happen if U was actually 1.06 and D was 0.94. It would all just automatically update itself and I wouldn't have to do any more work, which is kind of nice. And down here at the bottom, up here, I have the call up here and I have the corresponding put down here. The only difference is the payoffs, as you can see. The rest is the same. You're still discounting all those future cash flows at today's node. All right, so let me just quickly show you what that would look like. With the put, the payoffs are different, of course, because it's a put. But the discounting part and using the probabilities hasn't changed. So let's see how that would look differently. Oh no, this is a different example. Let me just show you what happened over here. In this case, the payoff in the upstate is 0. The payoff in the downstate is 5. So when you discount those back with the same risk neutral probabilities, you end up with a price of roughly 95 cents for the put. What's happening here is that we have 2 steps to our model instead of just one. We'll have to save that for next time because it's much more complicated, but we certainly will get the idea of how this thing works. So I think we'll stop right here. And of course, next week we'll go over the new material, but when we're done, we can come back and revisit this spreadsheet and see what else we were supposed to do tonight. This is definitely the longest lecture of the course. So I'm not surprised that we ran over a little, but it's totally worth it because it's very important to see how American options are priced, because these are still Europeans. Okay, we still haven't introduced or explained how you would adapt these models to price American options. And that's very, very important. All right, so sadly enough, now that also means I think we'll have to save this week's assignment until next week because we haven't really finished. So don't worry, you'll get to do it eventually. But for this week, I guess you're getting a week off. Actually, I think you had one last week, but that's okay. The assignment for this 7th week is very short anyway. So we'll have to wrap this up before you get this assignment, because otherwise you really won't know what to do. But in the meantime, I guess we better stop before we all pass out from all of this hard thinking. And I'll see you all next week at the normal time.
Quick question. Are you able to post the video from last week as well on YouTube?
Isn't it? It's not there? Did I really forget? Sorry about that. I'll take care of that right now as soon as we're done. I did not realize that I'd forgotten about it.
No problem.
I'm glad you reminded me because I actually completely forgot. I normally get them up there. I'm normally pretty good about it, but I don't know what must have happened that week. But all right, anyway, yes, other than that, are there any last minute questions?
I have a question.
Yes.
I wasn't sure. So for session 5 last week, there was not homework for it?
No, there wasn't. No, I
Okay.
couldn't think of any reasonable questions to ask.
Okay, because I was just looking at my email and I was like, oh no, I missed something.
No. There wasn't one. No, don't worry about it.
And for this week going forward, our homework is postponed until next week?
Yes, this one that you were supposed to do tonight can wait till next week because we're
Okay.
not completely done.
I have one more question. Sorry, I have so many questions today. Is there anywhere where we can check the scores of our homework, or just like see how we're doing?
Oh, I'm still working on that. You know what? The problem with what happened was you were unlucky because my semester in the daytime is ending up, and I'm up to my eyeballs in finals, and they have to be ready by a specific date. And the schedule was thrown off by the COVID on top of that. So after the next few days, I'll be able to get back and correct your assignments.
No problem. I just wanted to check.
Yeah, it just got sort of pushed aside because I'm under so much time pressure with my day classes.
Totally get it. Thank you.
Okay.
No problem.
Anyone else? All right, so see you all next week then.
Thank you.
Okay, bye.
Thank you.
Okay, you're welcome.